Well, hello and welcome to another Trade for a Living video here. This is Trader Tip number 5, and in this lesson I'm going to talk about trading versus investing. Now, a lot of people would wonder, why would I do a lesson like this? And the reason is because people get confused on the difference in trading versus investing. A lot of times whenever we talk about trading, people are thinking it's actually investing, and vice versa. When people talk about investing, they think it's trading. And so without understanding of the purpose of each, it can be really confusing here. So let me just kind of draw some comparisons so you can really figure out what you're thinking, and then you can understand where we're coming from here at TradeSmart and what we're teaching you to do. So I want to start with Bob. This is the traditional investor, Mr. Bob here, and Bob has a general philosophy. He says, when the market goes up, I make money, therefore up is good. Now, how many of you can identify with Bob? If the market goes up, you make money, up is good, and the corollary that goes with that is, if the market goes down, I lose money, therefore down is bad. Now, this is the traditional view, and the traditional view has some characteristics that go with it, such as the traditional investor will tend to buy and hold a trade, and they'll tend to do that for quite some time. Because they're buying stock, they want the market to go up. This is a very important issue right here. Because the majority of investors are more traditional, this idea that the market has to always go up is the predominant view. That's what you see relayed through the media. That's what you see in the news all the time. And so what happens is society and culture starts to think that, up markets are good markets, when in reality, markets can go either direction, and you can still make money either direction. But the culture wants the market to go up because they assume that that means that everything is good. Now, traditional investors also tend to trust other people to manage their money. Traditional investors tend to believe that, they really can't learn how to do it. They don't really want to take the time to learn how to do it, and they just kind of give the money over to others to let them manage it. They typically end up in trades for anywhere from 2 to 5 years or more. In fact, a lot of times you'll hear traditional wisdom saying you've got to be in the market for at least 5 years before you can expect to see any real profit out of it. You're going to really have a philosophy here at the end of the day that's really focused on saving money. This is kind of a big one. Whenever I talk to people who are wanting to get into investing, they say, well, I want to, be saving for my retirement, but I want to do it in a way that I can make more money than just putting my money in the bank account. So it's a variation of saving money rather than really, using your money for pure capitalism purposes here. And then, of course, at the end of the day, they're hoping for anywhere between a 15 to 20% return on an annual basis. And that's what most people consider to be really good. If you consistently grow at 15% a year, most people are really, really happy with those kind of numbers. So, question for you. Does this describe you? There's no right or wrong answer here. I'm not saying that one way is right. I'm not saying that one way is wrong. I'm just defining different schools of thought here and different philosophies. And so if it describes you, then great. If it doesn't, then great. Let's still compare the two. And let's ask the question, how well does Bob's philosophy work? So let's come over here and take a look at the chart. And this is the S&P 500. And, since the 1950s, my goodness, it works amazingly well. Look at that. I mean, the market just keeps going up. And if you buy and you hold it long enough, well, by golly, it's going to be good. And eventually everything works out in the end, right? Well, until the year 2000. Now let's zoom in and let's see what happened when we got to the year 2000. In the year 2000, some stuff started happening that was a little less than ideal. So we started to top out. This was actually in 1999, beginning of 2000. That's when the bull market of the 90s ran out of steam. And during the next couple of years here, we had a decline of about 30%. Now we followed that with a gain of 100%. And so we actually had higher highs as we came into 2007 and the beginning of 2008. Then we had, of course, the big sell-off in 2008. That's the one everybody talks about, where we had a 57% decline in the Dow Jones Industrial here. And then since then, from 2009 forward, we've had a 200% gain as the market has gone from about 6,500 here all the way to 18,000. And so it's been a roller coaster. Now, let's just talk about, we can talk about percentages, and that's one thing, but let's talk about what would happen if you put your money in here. And let's just start at the beginning of the year. I'm kind of picking arbitrary dates here. So let's say you invested $100,000 at the beginning of the year, January 1999, and you rode this entire roller coaster. A lot of people did this. A lot of people, especially people today, they've been in the market for 15 years now, and they're saying, man, things aren't working the way I thought they would. Those were the people who were buying back in 1999. Now, some of you have been in the market for 25 or 30 years, and you actually were able to get in a little bit earlier, but most people today are kind of in that 15-year mark, and so a lot of people started putting money in 1999, and if you put $100,000 in 1999, watch what happened a couple years later. By the end of that move, that $100,000 is only worth $70,000. Now, some of you experienced that. Some of you were fortunate, you didn't. Some of you got in 2003, and if you did, then great, you had a 100% gain, and your $100,000 is now turned into 140. But then 2008 came along, your $100,000 went from 100,000 down to 70, back up to 140, back down to 60 grand. I mean, now, you're 10 years into this and you've been losing money. And then, of course, if you kept holding, here we are, it's now worth 180. And so, yeah, it's true. You're making money over a 15-year period, but by golly, it's been a roller coaster. And if you're not ready to puke yet, you should be. And the big question that everybody wants to know is what happens if it does it again? What do I do? What if, when I need to retire, it happens to be on one of these downturns here, and I've, slashed my life savings in half here. So that's the big risk, and that's the big challenge of this philosophy of buying and holding for a long period of time. Now, this is the Dow Jones. What if we looked over here at the NASDAQ? The NASDAQ story would be even worse. If you jumped in around the same time, look here, we got a 75% decline. We had a 140% increase, then a 100% decline, and then we've had a 300% increase since then. So $100,000 would have gone down to 33, up to 79, down to 33, up to 133,000. And that's what you've got to realize. Every time there's a big drawdown like this, a 50% drawdown requires a 100% gain just to get back to even. And a lot of people don't realize that. And so these roller coasters emotionally and financially become devastating to people. And right now, here we are in 2015, the market's been roaring here. It's looking good, but markets are not going to keep going up forever. That's not the reality. Even though people would like for you to believe that, they don't keep going up. And one of the reasons that it's been happening over the last 15 years like this is because of the type of the market cycle we're in. You may have heard people refer to the lost decade, because that's what a lot of people feel like the early 2000s were. And people are hoping and wishing that right now, markets are in another, 40-year bull market. Well, the reality is it's probably not true. The reality is there's probably going to be some more of these cycles, because we're actually in an 80-year cycle where about every 80 years you start to have this kind of instability in the market. And that can last for 20 up to 25 or 30 years. And it's been a cycle that's been in play for several hundred years now, as long as really modern economics have been in place. So this is a known cycle, but most people are not aware of it because it usually happens once during someone's lifetime. And so the way that a lot of people react to this is they say, well, that's the overall index. I'm not going to try to do that. You start to hear people say, I want to beat the S&P. I want to beat the indexes. And so they go after individual stocks and they say, let me see if I can beat the indexes. Okay, so let's do that. Let's go over here to a company like Caterpillar. Caterpillar is a great company, solid underlying fundamentals. Got a great international presence. And let's not even go through the whole journey. Let's go during the strong years. Have you ever heard it said that anybody can make money in a bull market? Have you ever heard that? So since 2009, we've had a strong bull market here in the United States. So let's look at this here. What if back in 2011, January 2011, we buy into Caterpillar and we ride this wave forward? So let's go invest $10,000, maybe a little bit more. Normal sum for some of you. And if we rode this way for the last 4 years, here's what would happen 4 years later. That $10,000 has dropped down to about $9,435. And so here we've done what we thought we would do. We bought a solid company in a bull market, and 4 years later, we bought and held. 4 years later, basically we've gone nowhere. But we've been up and down. I mean, at the peak here, it's not that Caterpillar hasn't done anything. At the peak, we would have had a $12,000 portfolio here. In fact, that's happened a couple of times. Look, we've actually been up to this peak range a couple of times. That's a 27% gain. It's just that if you bought and held it for 4 years, it turned into a frustrating type of a situation. And so the question you've got to ask here is, what's the better way to do this? What's the better way to trade this type of a market? And I want to suggest to you that, what if we came along here and we purchased at the same time, but instead of buying and holding for a long time, what if we waited until the stock started to tell us it was going down? What if we learned to identify, hey, this is a topping pattern, and we've hit this top a couple of times now, and it's starting to break these patterns. Let's sell. And so if you buy and then you sell when you've got a profit, when we've run up to some topping levels, well, look what we could have done here with Caterpillar. We could have actually made $25 a share. Now, while the market's going down, you just stay in cash. You don't do anything. Then before you know it, the trade's turned around. We've got some buy signals. We can do the exact same thing, ride it up, and then when you start to get the sell signals, we sell again. Now we take in another $25 a share. And if we wait for the next set of buy signals that happened in 2014, well, we could have pulled in another $15 a share. So you notice between these three trades, it's better than 25% profits twice here, and then you got about a 15-20% profit on one of these moves. Over the last 4 years, there was over $65 worth of a fairly easy profit on Caterpillar, but you couldn't buy and hold. You had to buy and sell, and you had to constantly be buying and selling. Now, this is not day trading. You notice we're not sitting here, sitting in the computer all the time. If you look at these swings, we're talking about this was a 6-month window. In most of these cases, they're about 6-month moves that you're looking for here. And so it's not day trading. It's just more active swing trading. Now, this is just if we were to trade the upside. You've got at least $65 a share. You probably could have made more, but there's at least $65 a share profit. What if we traded the downside? A lot of people think that up is the only way you can make money, but what if we did make money while the stock was coming down? Well, it turns out there was 3 huge opportunities during the last 4 years, and we could have made between $80 and $90 a share if you combine just the downside in there. So you put those two together, you could have doubled your money easily, probably a couple of times here, just trading Caterpillar. If you're trading the stock, you could have doubled your money. If you're trading some options, you could have done it a few times here. And here's the key, and here's the point that I'm trying to make. If you just simply buy and hold when you're in markets that are cycling and they're going up and they're going down, if you simply buy and hold, it becomes an emotional roller coaster. It becomes very frustrating. But if you learn to be more active about it, you don't have to be a day trader. You just need to be recognizing those kind of more intermediate term trends when they're cycling over. And this is what active trading is really about. And so let me introduce you to Sam here. Sam is an active trader. He's constantly buying and selling. On those pictures that you just saw is more of a 6-month swing. Typical active traders are going to be in a trade anywhere from a couple of days up to a couple of months. Now, you could expand that on out to about a 6-month view like I showed you there on those couple of trades. But typically speaking, we're looking at a couple of days up to a couple of months. Now, in terms of do we want the market to go up, it's not about the market going up. Active traders just want the market to move. Active traders are equally comfortable being bullish or bearish, and they recognize that up is not necessarily good and down is not necessarily bad. They just simply are the moves of the market. Active traders tend to manage their own money. They don't tend to trust other people. And here's really a big key for you here. Active traders are focused on using the market to create cash. They don't see the market as a big savings account. They see it as a tool for investing cash and creating cash, not a place where you can just store money so you can go build up some retirement. And at the end of the day, here's what happens. Active traders, depending on how they're trading, depending on the techniques and the strategies, it's not uncommon at all for active traders to be making a 20% profit on a monthly basis, possibly even more. And so active trading and investing are 2 different schools of thought. That's why I'm doing this video, because a lot of people get confused here. They think that when we talk about trading, they're thinking, oh, this is all about, buying and holding for a long time. It's really not. It's a completely different philosophy. It's a completely different school of thought. So let's just compare them straight up here. Traditional investing, buy and hold, want the market to go up, tend to trust others to manage their money. They're in a trade for 2 to 5 years or more, focused on saving money, looking at a 15 to 20% return for a year. And this is a much longer term, bigger picture view. Whereas you look at the active trader and you say, we're constantly buying and selling. They just want the market to move. They They don't even care if it's up or down, managing their own money in a trade for a couple days up to a couple months. And what's great about this here is, you don't have to wait 5 years to figure out if you were right. You can adjust very quickly. Focused on creating cash, not necessarily saving. And, they can looking at maybe 20, 30, 40% on a monthly basis. Again, that depends on the strategies that are used, but making monthly income is the key here. And then, of course, they're using the market for short-term gain as opposed to the long-term view. Now, let me give you a couple disclaimers here before you go out and think that all short-term traders are, raking in 20 or 30% on a monthly basis. Active traders are typically trading a little bit smaller account. So if you've got a $8 or $10 million account, you're not going to be able to move that much money as flexibly maybe as you need to make some of those really active short-term gains. Typical active traders are going to be trading between $10,000 and a couple $100,000. That's going to be your typical trading account for an active trader, somebody that's moving money that quickly there. All right, next you need to know that they're typically using leveraged instruments. So you're going to see the higher gains if they're using some margin, or what we typically do is we'll trade with stock options, and that's what really active traders usually will gravitate towards, is using stock options, something that's going to provide a little bit more leverage and a little bit less risk if the trade doesn't do what they think it's going to do. And then finally, more active traders, it's going to vary, obviously. The profits are going to vary based on experience and based on training levels. So those are really some keys to making sure that you're making the profits that an active trader can make. But if you'll learn to do that, then certainly there's no reason you cannot be an active trader as well. What you need to know specifically is that active trading, it's a new skill set. It's a different way of thinking about the market, and it's just a different skill set. But once you learn it, once you learn how to flow with the market in that way, it can be really quite rewarding for you. So if you want to learn more, how can you do it? Well, you can watch some more of these Trade for a Living videos. These are little snippets from some of our classes that we have here at TradeSmart. And if you want to really get involved, well, by golly, come over to TradeSmartU.com, and you can learn all about active trading, all about trading for a living. We got hundreds of hours of training available on our website, all available on demand for one monthly price. You can cancel anytime if you choose that the training and the membership is not for you. So if you want to do that, just head on over to TradeSmartU.com, and I look forward to seeing you in some of our classes over at TradeSmart. And until we meet again, happy trading to all of you.